Arrowhead and Zurich have teamed up to offer multi-line package coverages at competitive prices. We're bringing new life to ambulance insurance. Learn more at arrowheadgrp.com/ambulance.
While Sandy's damage is still being tallied, the picture for the property casualty insurance industry is looking better, says Steve Wesibart, Chief Economist for the industry's Insurance Information Institute. In this interview with Insurance Journal's Andy Simpson, Weisbart provides his forecast for the economy and the property casualty insurance industry in 2013 and identifies sectors he thinks will lead the recovery.
Well, right now, I think obviously the big unknown in terms of the fourth quarter is how bad Sandy's claims are going to be. At this point, it looks like the combined ratio for the industry would be somewhere between 105 and 110, which was 107 last year. So it could be worse, maybe not. It's hard to say, but in that ballpark, I think. In terms of return on equity, we're talking low single digits, I would say. Through the first three quarters, it was about 6.5, but Sandy claims will drag it down probably in the between 3 and 5, somewhere in there.
Is that where it was in 2011?
It was about 4% in 2011. This will be 2 years in a row we've had massive catastrophe losses that have affected the combined ratio and the return on equity. Workers' comp's getting a little better than it had been. Major premium revenue increases, something close to 10% for 2012. It's painfully obvious that we've been running combined ratios above 110, and that's not a sustainable business model. So insurers are when they can, raising rates to try to bring that back into some kind of balance. And I think that will continue to generally happen in 2013. Probably not to bring the combined ratio all the way down to 100, but to move it in the right direction. A couple of things are weighing it down. Number one, I think the loss of the kind of investment earning power that we had years ago is a major factor. One of the slides that we like to use in the presentations that Bob Hartwig and I do shows the combined ratio from various historical years and the return on equity for those same years. In that chart, in 1979, for example, the combined ratio for the industry was about 100.5, and the return on equity was nearly 16%. Around 2005, the combined ratio was almost exactly the same, 100.5 or so. Return on equity was 9.6%. And then in 2010, same combined ratio, return on equity 7.5%. It keeps coming down in spite of the fact that the combined ratio was the same because the investment earnings were lower. And what we have today and for the next couple of years probably is an investment environment that is going to be more of this enormously low interest rate environment. And since bonds are 2/3 of what property and casualty companies invest in, that means not much in the way of investment income. So I think that's going to weigh most heavily on the return on equity for the next couple of years. Another thing is that if we keep getting cat years as expensive as the last two, 35, 37 billion each year, that's numbers of that size are not currently built into the rate structure. An occasional cat year, sure. Every single year, no. And so that's another thing that's weighing down, at least historically, on the return on equity. In the past, insurers have relied on their investment income essentially to assist, let's call it, the underwriting side of the house to pay the claims that incur. And you could run a combined ratio in the over 100 and still make a very satisfactory profit if you had enough investment income. But without that, you pretty much have all of the pressure on the underwriting side of the house to earn the organization's profit, and that's very hard to do. I think most economists expect the next couple of years to be gradually improving from where we are today, and I think that's a pretty reasonable situation for a forecast for the economy. I do think that the jobs environment will reasonably continue to improve. In a small way, I think you have to recognize that there's a benefit to the job market by the baby boomer generation moving into their retirement years. That'll open up slots for people who are younger and need to be in a paying job for the rest of their career. So even if we don't have a larger number of jobs, which we will as the economy grows, you'll have a better employment ratio from the younger people taking the jobs of those who retire. In terms of construction, again, I think the picture is gradually brightening. Right now, we're looking at residential construction probably up 15% or more each year. Part of that is because it's compared to a very low base. We were practically not building any new houses at all. But as you have to replace houses that get old and fall down, others burn down, and so we're going to be and of course the population's getting larger, both from a limited amount of immigration and just natural birth and all. So we need more housing units, and we will build them in the next couple of years. Some other construction, I think, will also expand at a very nice rate, depending on how we decide about things like public schools. There may be substantial construction there. Our transportation system needs major upgrade in terms of things that are bridges that are in danger of falling down. And as long as there's a willingness to spend on basic infrastructure, I think the construction industry will pick up nicely. Oh, absolutely. One of the sectors of the economy that, at least at the moment, seems to be growing very quickly with commensurate insurance requirements is the energy industry. We've turned into a country that is producing enormous amounts of natural gas and even crude oil. And that means large amounts of money pouring into the areas where that's happening, and a commensurate insurance bill for protecting not just the commercial activities, but the personal insurance needs that go along with that. Not only workers' comp, but private passenger auto, homeowners, all that sort of stuff. So I think in places where energy is intensifying, everywhere from North Dakota to Texas and other places where they find that, there will be a major increase in insurance activity as well. Also, to the degree that the situation in places like Europe improves and our trade balance with them improves, states that have large exporting activities will benefit more than states that do not. So international trade can have an effect on where the activity is as well. The healthcare sector and its things that are related to it will continue to have, I think, a significant growth. One of the things that this is potentially a very creative time is in developing ways to provide medical care either at less cost than we've been spending in the past or to more people at the same cost. One of the things I believe is true about the Affordable Care Act, so-called Obamacare, is that it tries to fund new ideas in providing health care, and to the degree they are successful, then hopes that they will spread. So if there are creative experiments in engineering, and I mean that in the general sense, of new ways to provide quality health care, I think the insurance market will follow there very closely as well.